Will 2026 witness a collapse? That's the question whispered by pale-faced amateurs huddled on the sidelines. But to the real operators in Manhattan or Canary Wharf, the question sounds almost childlike, because it assumes the beast coming toward us is a sudden crash. The truth is far harsher. We're being dragged into a slow grinding squeeze, an era I call, plainly, war economics. Look at the world without the glossy varnish of mainstream media. Macro peace has expired. Gunfire in Eastern Europe, flames rising across the Middle East, and the Cold Roar over the Taiwan Strait aren't just morning headlines. They are punches straight into the arteries of global trade. They turn inflation from a temporary glitch into a built-in feature of the Western economic system. Not a mistake, not an anomaly, a new structure. As we step into 2026, the world is no longer governed by optimal efficiency, but by one overriding priority: national security. And when governments elevate security above economics, the outcome becomes inevitable. Surging defense budgets, supply chain rewiring, and waves of new sovereign debt flooding the market like a breached dam. This is the macro breaking point, a glut of government bonds. Yields snapping upward like compressed springs, liquidity draining out of every risk asset in sight. And in that landscape, gold returns to the throne. No longer jewelry, no longer the asset Buffett mocked, but the only asset without counterparty risk. When Asian central banks buy gold as if war is scheduled for tomorrow, when confidence in U.S. treasuries trembles under the weight of fiscal deficits, when the world begins asking the question no one dared to ask before: what happens if the dollar is no longer the sole judge? Gold becomes the silent vote against the erosion of fiat. If your portfolio walks into 2026 without gold, energy, land, commodities, or real assets, you're walking barefoot across a minefield. Because geopolitical tension isn't merely a risk, it reprices the entire market. We're witnessing relentless global fragmentation. Oil, gas, and energy no longer trade on pure supply and demand. They move along political power lines. Energy prices settle into a permanently higher plateau, and that creates a form of stagflation that crushes the margins of companies built on cheap inputs. Smart money saw this long before the crowd, and it moves with ice-cold precision, dumping consumer stocks dependent on cheap credit, exiting over-leveraged companies hoping for a miracle refinancing, and rotating into defense, energy, agriculture, sectors the world must buy whether the economy is booming or burning. Rallies? Just bear traps. Those little pops aren't hope, they're breathers before the saw blade grinds lower. The economy of 2026 may not fall like 2008. No single explosion. No second Lehman. Instead, it will erode the middle class through stubborn inflation and immovable interest rates. The survivors won't be the optimists, not the ones praying for a market comeback, but those who understand one simple truth. In the age of cheap money, everyone was a genius. In the age of economic warfare, only those holding real assets and a mind cold as steel will still be standing. As the dust from the macro quake begins to settle, another scene emerges. Brutal, silent, and far more dangerous. The death of beta, and with it, the collapse of the passive investing illusion that lulled the world to sleep. For an entire decade, you could be the laziest person alive, throw money into an ETF that tracks the S&P 500, and still walk away with double-digit returns. Not because you were smart, not because businesses were improving, but because liquidity lifted every wrecked ship off the ocean floor. But 2026 is the year the tide goes out. And when the water recedes, the naked truth always appears. Nothing rises anymore. We are entering the great bifurcation, the era of extreme dispersion. The market is no longer a communal basket of assets. It's a battleground where companies with fortress balance sheets survive and the rest die of capital starvation. Take a hard look at Silicon Valley. The trillion TAM fantasies, the burn cash now, the future will shine later fairy tales, now worth less than scrap paper. By early 2026, Wall Street has run out of patience for CEOs talking about 2030, while their compensation plans and stock option packages swell like toxic mushrooms. A 5% risk-free rate acts like acid. It melts every valuation built on hope. It erases every business model without positive free cash flow. And this is where true alpha finally reveals itself. Alpha isn't about picking winners. Alpha is the skill of rejecting losers. Smart money is fleeing zombie tech. companies that survive on transfusions, refinance to breathe, and sell the future to buy time. Capital is flooding instead into infrastructure monopolies, empires that control data, control the cloud, and control semiconductors. They don't need banks. They are the banks. They have enough cash to swallow competitors in panic and enough firepower to buy back their own stock when the market trembles. But the sharpest edge of 2026 isn't in tech, it's in the rise of the physical economy. While the crowd is still mesmerized by virtual models, the seasoned predators are quietly accumulating the assets the world chronically undervalues. Heavy industry, logistics, mining. Not glamorous, not sexy, but they control reality. In a world fractured by conflict and supply chain rewiring, owning a copper mine in South America or a steel mill in the Rust Belt is a strategic asset worth 1,000 times more than any burn cash for market share tech app. This is the return of value stocks, but not the old PE bargain bin. This is the value of physical scarcity. Stubborn inflation is shifting power from the consumer to the producer. Whoever owns what can be dug, produced, or transported rules. Whoever owns promises on paper gets crushed. And looming behind all of it is the ticking bomb called private credit and commercial real estate. This is the dark room where the bodies are buried. Trillions of subprime loans packaged into safe yield and stuffed into the portfolios of pensions, insurers, and investors who have no idea what they actually own. But with rates locked high, the 2026 maturity wall will expose everything. Empty office towers in Chicago, New York, San Francisco aren't just cold slabs of concrete. They are unexploded financial ordnance waiting for the timer to hit zero. They can rip through the balance sheets of regional banks. But smart money doesn't dive to catch falling knives. They wait. They stay patient. They buy when the market detonates and assets trade at scrap metal levels, cents on the dollar. 2026 is the year everything flips. Cash is no longer trash like in the stimulus era. Cash becomes a perpetual call option on every asset thrown into liquidation. And the line between survivors and casualties reduces to 3 words: patience, cold blood, ruthlessness. If you think the brutality of 2026 ends with your portfolio shrinking or your mortgage rate exploding, you're looking in the wrong direction. You're only seeing the tip of the iceberg. Beneath the surface lies another seismic layer, darker, deeper, and far more dangerous: the unraveling of the social contract and the great illusion known as private market valuations. When the fog over public markets clears, what's left is an economy that has been hollowed out. The middle class, the consumption engine of the West for 7 decades, is being crushed by 2 unstoppable forces: artificial intelligence and lifestyle inflation. Forget the 4% or 5% unemployment print. Those are outdated metrics propped up by obsolete definitions. The colder truth is this: white-collar work is evaporating permanently. 2026 marks the end of the era of high wages for average skills. The companies of the S&P 500 are executing the largest labor restructuring in modern history, neatly packaged under the euphemism of performance optimization. And they're not cutting factory workers. They're surgically removing middle managers, junior analysts, and administrative staff. The people earning $100 a year for tasks a $50 a month algorithm now does better. This is the new engine of margin expansion, stronger than any tech upgrade. For capital owners, it's divine intervention. For workers, it's a deflationary wage apocalypse. Wall Street sees this long before the unemployment data catches up. They're long companies selling the technologies that replace humans, and short businesses dependent on the fading purchasing power of a suffocating middle class. The consumer economy doesn't collapse with a bang. It suffocates slowly. But the biggest systemic threat isn't the labor market. It sits where the light doesn't reach: the shadow banking system and the private credit bubble. Strip away the glossy language. This is a legally sanctioned Ponzi worth tens of trillions. During the zero-rate decade, when traditional banks were shackled by capital safety rules, risk capital flooded into private credit and private equity. This $15 trillion industry rests on a polished lie: valuation stability, not mark-to-market, mark-to-model, or more accurately, mark-to-fantasy. They price their assets using internal models while ignoring the brutal reality of public markets. But 2026 forces everyone back into the real world. With the risk-free rate at 5%, these funds continue reporting gains based on the enchanted valuations of 2021, all the way until redemption requests start knocking. When liquidity is demanded, the fairy tale ends. That's when the maturity wall hits. Trillions in debt owed by private equity portfolio companies come due at the same time. These companies, bled dry to fund dividends for their PE owners, now must refinance at double-digit rates. They can't. They'll default. And when they default, the funds must mark losses. When that happens, their largest LPs, pension funds, will panic. The baby boomers are being betrayed on the eve of retirement. Chasing yield, pensions plunged into these illiquid private assets. They thought they were buying safety. In reality, they bought timers strapped to explosives. And when retirements peak in 2026, they'll need cash. They'll request redemptions. The gates will close. Liquidity will vanish. To pay retirees, funds will be forced to sell the only things still liquid: blue chip equities and high-quality bonds. And that's how the private market implosion bleeds into public market panic. Even the best assets get dragged down. But don't just look west. Look at the map and you'll see a new monetary order forming: the BRICS plus commodity cartel. While the West prints money, the East stockpiles resources. The West thinks inflation can be crushed with higher rates. But inflation's root is physical supply, and they don't control it. In 2026, supply chains are weaponized for real. Oil is just the opening act. Copper, uranium, rare earths, food all become geopolitical pressure points. Resource-rich nations no longer accept trading real commodities for U.S. Treasury IOUs. They want gold. They want commodity-backed currencies. They want barter. The West enters an era of permanent imported inflation. Younger generations will be priced out of home ownership. The economy transitions into a subscription-based existence. You own nothing, and you're expected to smile about it. And eventually, governments enter the stage, not to save you, but to save themselves. They will choose financial repression, forcing institutions to buy government debt at yields below real inflation, tightening capital controls, raising wealth taxes, inheritance taxes, and pseudo-environmental levies. Every path narrows. Savers are punished. Holders of real assets are rewarded. 2026 is not a year for dreamers. It's the go board for those who understand that cash is oxygen, real assets are shields, and financial flow literacy is the only weapon that matters. Those who cling to old models, rely on the government safety net, or hope for a pre-pandemic revival will become exit liquidity for the elite. This is the greatest wealth transfer of the century. Choose your side before the music stops, because when it does, there won't be a chair left. If you think the labor market and private credit are the two biggest pressure points of 2026, then you still haven't looked into the real abyss, the balance sheets of entire nations. This is no longer about inflation, and it's not about recession either. This is fiscal dominance. The moment when public debt grows so massive that central banks stop steering the economy and instead get dragged around by the Treasury like financial hostages. The cold numbers are exposing the lies of politicians. In the US and across the G7, interest expenses have already surpassed defense budgets. Let that sink in. That means the world's superpowers are no longer spending money to defend their nations. They're spending money to defend their decaying past. A country that can print its own currency will never declare bankruptcy, but it has a far more elegant method: inflation, a covert default, a silent tax on society, and the knockout blow will come from the bond market itself. Once yields return to the 6 to 7% range, the level that can detonate entire national budgets, central banks will be forced to revive yield curve control. They will print, they will buy bonds, they will bend the market with quantitative force. That's the moment a currency dies functionally. It stops measuring value. It becomes a tool for the state to drain society. In that environment, the sharpest money on Wall Street has already rotated. They're running a barbell strategy, one end in gold and ultra-short T-bills, the other in a free upside option on the failure of the fiat system. And Bitcoin has increasingly become that option. Don't kid yourself. Bitcoin is no longer a toy for programmers. After spot ETFs were approved, Bitcoin turned into a macro asset, a kind of CDS on the fiat monetary regime. Pension funds and family offices aren't buying Bitcoin because they like blockchain. They're buying it because they need an asset that cannot be confiscated, cannot be diluted, and cannot be manipulated by politicians. But make no mistake, the altcoin market is a graveyard. 2026 will incinerate 99% of tokens, leaving only Bitcoin and a few protocols with real cash flow. This is not a downtrend, this is systemic purification. And while the monetary war unfolds, another front has opened: energy. The ESG fantasy has run its course. A world powered by AI, data centers, and compute-hungry models cannot run on wind and solar. Electricity demand has surged tenfold. Grids are nearing overload. There is only one solution: nuclear and natural gas. Uranium is becoming the new oil. Governments are reversing course, reopening nuclear permits, and pouring billions into small modular reactor technology. Wall Street is loading up on uranium, utilities, and traditional energy infrastructure. Meanwhile, subsidy-dependent renewables will collapse as high rates choke their cost of capital. As for global capital flows, they've turned brutally selective. The Global South has stopped selling resources at discount prices. They're imposing taxes, nationalizing mines, and tightening export controls. A copper mine in Canada is worth 5 times 1 in an unstable jurisdiction. Rule of law is now a form of alpha. And all of this converges into a single theme: the reversion to real value. The world is abandoning financial engineering, debt-based promises, and growth illusions. It's returning to 3 things that cannot be faked: atoms, bits, and gold. Governments will respond with CBDCs, the ultimate financial surveillance tool, but markets will find ways to slip through the cage. The war between state money and private money will define the decade. And to survive, you must align yourself with assets that cannot be diluted, seized, or censored. This is not pessimism. This is a survival map. Most of the crowd will be crushed between these structural shifts. Don't be one of them. We've walked through the 4 layers of macro hell: inflation, the asset bubble, the lies of the shadow banking system, and the silent default of nations. And now, standing at the doorstep of 2026, the most important question is no longer where the market is headed. The real question is, what will you do to avoid being ground into dust? This is part 5, and it is the obituary for the passive investing mindset of the last century. Throw away the 60-40 strategy that lazy financial advisors keep chanting like some tired spell. In a world of stagflation, stocks and bonds are no longer opposite poles of a balanced portfolio. They're accomplices in the same crime. When rates rise to crush inflation, both sink like stones. 60-40 isn't a lifeboat, it's the rock tied to your ankle. 2026 will deliver a brutal truth. No one is coming to save you. No one will lift you up. No one cares if you swim or drown. Central banks are busy saving governments. Governments are busy saving banks, and pension funds are busy saving themselves from the hole they spent 2 decades digging. You are the last line of defense for your family. And that leads to a profound philosophical shift in investing, from indirect ownership to direct ownership. In the era of cheap money, you could feel comfortable holding a piece of paper that claimed you owned gold in someone's vault, or a flashing number on a crypto exchange whose office you couldn't even locate. But when counterparty risk peaks, those papers become decorations, useless and dangerous. 2026 will draw a vicious line between asset holders and promise holders. If you don't hold the private key, you don't own Bitcoin. If your gold sits inside the banking system, you own risk, not metal. Smart money already understands this. They're stripping their wealth away from financial intermediaries. They're privatizing their own capital. And you should too. The survival strategy for 2026 isn't broad diversification. It's concentration in liquidity and scarcity, the 2 things that cannot be printed. Think of your portfolio as a fortress. The moat: pure liquidity, ultra-short cash, T-bills under 90 days, and foreign currencies from fiscally disciplined nations like Singapore and Switzerland. This isn't an investment. This is ammunition. The watchtower: insurance assets, gold, Bitcoin. You don't buy them to profit. You hold them so you never have to kneel when the monetary system resets. The granary: survival cash flow, energy, agriculture, and data companies, businesses that can pass costs to consumers in real time. Their dividends aren't rewards. They're oxygen. But your strongest weapon isn't in the portfolio. It's psychological. The market of 2026 will be engineered to eject you from your best positions. Volatility won't just be high, it will be destructive. Gold might drop 20% in a week due to liquidity stress, then surge 50% when the Fed is forced to print again. The crowd will panic sell the bottom and FOMO into the top. To survive, you must become a financial stoic. Price is noise. Macro structure is signal. Don't believe in geographic safety. There is no perfectly safe place, only less bad ones. Global capital is fleeing. The elite are performing legal arbitrage, earning money where liquidity is high, storing wealth where seizure risk is low. If all your assets sit in one country, one currency, one legal system, you're betting your family's life on the kindness of a desperate government. 2026 will trigger the greatest wealth transfer in history. But don't get it twisted. This is not a transfer from the rich to the poor. It's a transfer from the uninformed to the informed. Inflation is a tax on naivety. Cash holders pay the borrowers. Paper asset holders pay the real asset holders. Emotional traders pay the disciplined ones. The door is closing. The easy money era is dead. What's left is a ruthless arena where Darwinian selection reigns. You have the map, but the map is not the territory. The question is, will you step forward? In the storm, the turkey looks up, prays, and drowns. The eagle uses the same wind to rise higher. Be the eagle. See you on the other side of the Great Reset. If you found these insights valuable, make sure to subscribe to Trading Mindset Lab. Drop your thoughts in the comments, and don't forget to hit the notification bell so you never miss a video on trading strategy, market psychology, or critical macro warnings. One click or link from you might be the edge others don't have.